will be, again, we'll try to make it as interactive as possible. Today's discussion going to be a little lengthy because we are going to cover a lot of topics, and I'll see if I can finish it within the time period. Yesterday, there was one slide I think I skipped over. I will start with that presentation as a recap for yesterday's discussion. Okay. Again, we're talking about financial statement fraud. This is particularly of use to people who works in the external audit background or forensic accounting background, but also for internal audit people, professionals who are involved in doing the financial audit of a company. The only thing is for an internal auditor to see the big picture is difficult because they usually take a particular segment and they work on that segment, but they do identify issues. We'll talk about it later, how important it is to read the internal audit reports and try to interpret the results and extrapolate it on its impact on the financial statement taken as a whole. For external auditors, it's easier because they're looking at the financial statement at a much taken as a whole. So most of the discussion will be very, very useful for them. Yesterday, one thing I skipped over is the financial statement effect of inventory and cost of goods sold fraud. Now, what happened is if inventory is overstated, what will be the effect on the financial statement for income statement, for example? Because at the end, the companies are trying to really boost up their net income, because a reader of financial statement or investors, they are looking at, first thing they'll look at how the company is doing on the net income side. Second, they'll look at how they're doing on the revenue side. These are the two key factors most of the investors, the analysts, they pay a lot of focus on. So from a management fraud, management wants to their revenue looking good, the income looking good. So this is what they want. So what happened if the inventory is overstated, then it has no effect on the gross revenue. It does not have effect on the sales return or the sales discount or the net revenue. It's not impacting that. But cost of goods sold, that is understated. So if the cost of goods sold is understated, gross margin will be overstated. If the gross margin is overstated, it doesn't impact the expense either. So your net income is overstated. So if you have the same expense and you increase your gross margin, obviously your net income is going to be overstated. So that's why they are interested in fudging the inventory number or cost of goods sold number. Now, from a purely inventory perspective, what is happening? When you're doing your fudging inventory, your beginning inventory is not impacted from the period one, but next period, it is overstated. Purchase of inventory, not impacted because you didn't really add new inventory. You're just playing with the existing inventory number. Return on inventory, not impacted. Purchase discount, not impacted. Goods available for sale, not impacted because it is not changing. You're just fudging the number. Ending inventory is overstated. Cost of goods sold is understated because if the rule is, if you're selling more, your cost of goods sold should go up, the inventory should go down. So when you are keeping the inventory high, so you're basically taking the number out of the cost of goods sold to make your net income look better. So these are the things that we need to pay attention as how that our inventory manipulation is going to impact our financial, the top numbers. Okay. Anyway, that was a recap from yesterday. Now, today's discussion will focus on liability, assets, and inadequate disclosure, financial statement disclosure fraud. So we'll talk about the fraudulent schemes that understate liabilities and impact of understated liabilities or the liabilities fraud, fraudulent scheme that overstate assets, Understand the overstatement of asset fraud, list fraudulent schemes that inadequately disclose financial statement information, explain the inadequate disclosure fraud. Now remember, when we are looking at financial statement, we are looking at the disclosure and MD&A, management discussion and analysis. These are all part of the overall financial statement. The information we are presenting to the investor and the creditor and all other stakeholders, shareholders, it includes income statement, balance sheet, net worth, cash flow statement, disclosures, and management discussion and analysis. Anywhere we make a misrepresentation or omit any critical information is going to mislead the investors. So we have to pay attention to that. Now, the question is, why it is so hard for auditors to detect fraud? One is the collusion by insiders or outsiders, as well as the case with, if there is an insider outsider collusion, it's difficult to discover fraud. For example, if you are working with your customer to increase the sale, so you have account receivable balance, that confirmation is sent, and you already tipped off the customer, then your confirmation may be wrong. But in that case, auditors will never be able to catch it because they did an independent confirmation, it came wrong. Collusion is very difficult to discover. Then the question of forgery. Now, sometimes the auditors are not trained to detect the financial statement fraud. Okay, this type of training needs to be there. If you leave the critical part of the audit to a new auditor, you will be risking this particular area because they are not trained yet. You need to have experienced person looking into these numbers. Complex audit trail. Now, remember I always highlight the internal audit report. The internal auditors, they are doing the company's internal operational audit, financial audit, technical audit in a segment by segment basis. They have a whole year audit program and they go take one segment, do it, move on to the next one, do it, move on to the next one. Sometime for each of the audit section they are doing, they will find issues, they will document it, but sometimes they are not reviewing it as a whole. As an external auditor, it is very, very important, or an investigator is very, very important that you take the internal audit report and try to see it as a whole. In one case that I have worked on, that we were doing internal audit function. I was doing treasury, another was doing fixed asset audit, another was doing revenue audit. And suddenly, because we were colleagues, we would discuss with each other, we kind of noticed that there is a trend going on there. There are some problem with the fixed asset that has impact on the treasury. That is something I'm finding out in the treasury audit also. And another one doing a revenue audit, he is also identifying some issues that started raising question. So we set up a committee among us to share the results of our individual audits. And when we started putting it together, then the whole picture came out that something is funny going on in the organization. Then we could report it back to the management. So that was one area that thing because of all of us came from external audit background and I am a forensic audit background, that combined experience really, really helped to identify the anomalies that we are looking at different segment of the internal audit. As external auditor, I suggest the same thing. You need to review the internal audit report. You must review the internal audit report. Try to understand and take those results in a holistic way, in the big picture way, and see if there's a trend going on. There's some particular control issues that is going to impact your financial audit. Okay. Lies, that is when you go for your meeting with the top management about analyticals or any significant discrepancies, management will lie to you straight. In those cases, it's difficult to discover fraud. Normal looking transaction, in every other way, these transactions are the way it should be in normal business transaction. But these are fake transactions, or they have manipulated the number. So it's difficult to detect right away. Silence, the people who are involved in doing, in committing this fraud, or we are forced to work on this type of fraud, they know they're doing something wrong, but they kept silent because they risk losing their job, they risk getting reprimanded or disciplined. In one case, I told you, the manager in the financial reporting section, he could not take it anymore. He realized that what his manager was asking him to do, excuse me, was blatantly wrong. So, and he had the courage. So what he did, he quit the job, he left the country. So he got himself in a safe position first. Then he disclosed the whole fraud to the top management. Of the book fraud, that is in all matter, the transaction looks legit, but is the other side of the transaction is to a company that you don't have access to. So you really can see the transaction on the other side, the other company. That's usually the vehicle used by Enron, WorldCom, Tyco to record their losses. Okay, so the off the book fraud is another thing, is difficult to trace because it's not those entities are not consolidated. And I told you about the telecom companies in the 2000-2001, the companies related to WorldCom, Enron, Quest Communication, and several other companies. These are telecom companies. They're doing a lot of transactions. These are independently listed companies. They're not, their board or anybody, no one is related to each other, but all the top management are consciously doing some transactions. They are fraudulent in nature. So in those cases, it's very difficult to trace the actual fraud. Misleading documents, the documents are manipulated or replaced or somehow created in such a way that it gives you wrong information. And sometimes the bigger frauds are broken into small segments, especially the telecom fraud I was referring to. The transactions from WorldCom to 10 different other companies, and when you take them together, then it becomes a massive amount. But on its own, it usually falls below the materiality threshold. And the first time fraudster, you have done background check on the individuals and told you, I think in my first training session 2 weeks back, 3 weeks back, that most of the fraudster, you cannot really profile them. Somebody who's been honest all their life, suddenly they will switch into a different mode. So in those cases, your background check is not going to reveal anything. So those are the risks that we have in identifying fraud in a financial statement. Now, how the liability and revenue frauds are committed. So to financial statement to look good, you want to understate the liabilities and overstate the revenue. If you can do that, your financial statement is going to look really, really good. That is going to impress your investors and everybody. And that's what we have seen consistently being done in all the company that we, SEC is investigating, all the investigations that is done globally. Now, types of financial statement fraud, we have understating liabilities, overstating assets, and inadequate disclosure. So these are the three components that you will see, and we'll get into detail one by one today. In the waste management case, they have done all three of these, okay, including the fudging the revenue. Once you start committing financial statement fraud, you really can't stop. You have to keep on doing it. You start with revenue, then you see that you can't do much on revenue, so you start releasing the liabilities. Then you say, okay, that is not even enough, so overstate the assets. That is not even enough, so you go for inadequate disclosures. Your contingent liabilities are disclosed, and it never ends. And you end up digging a deeper and deeper hole, and you never can come out of it. Now, understatement liabilities, for what are the schemes that you want to do? I'm telling you, first, you have to put yourself in the mindset of that if I am going to do this, how are you going to be done? So you have to put your mindset should be in the like the fraudster. If you can think like a fraudster, you will be able to discover fraud. It's almost like that movie, Catch Me If You Can. He used to pretend like a flight attendant, a pilot, and he was able to get through. So it's all about in your mindset. So the schemes are: you understate accounts payable, understate accrued liabilities. In WorldCom case, I told you that I worked on the accrued liabilities section, and about 110 million was there. I was able to discover, and total was 11 billion on the revenue side fraud. Recognize unearned revenue as earned revenue, that revenue that you have not earned yet. For example, especially in the companies like the media and telecom provider, where you bill at the beginning of the month, or you sometimes collect the whole year's money in the first month, and then you have to allocate it over the 12 months period. Some companies will immediately recognize the whole amount as if like it has been earned that month to meet the target gap they have. So we'll discuss it in detail later on. Under recorded future obligation, not recording or under recording various types of debts, note, mortgage, and omission of contingent liabilities. These are all related. We'll talk about it one by one. Now, how liability fraud is committed? One is, don't record purchase or record it in the next accounting period. So smoothing the curve. So it could happen that the purchase you made, if you record it this month, your liabilities is going to go up because you're purchased on credit. So you try to defer it to somehow change the number, the documentation, somehow you try to show it in the next accounting period so that this accounting period looks good. Overstate purchase returns and allowances. Okay, so that overall liability shows a lower number. Now remember, the people who are doing this, they know they're doing something wrong. We're talking about fraud. Fraud means it is not by error. It is by intention. We talked about in the first session 3 weeks back that there's 7 elements of fraud. In all of these things that we're talking about, the 7 elements are there. One of the key elements is the intent. So people who are doing it, it's not only one transaction in a year. They will be doing hundreds and thousands of transactions in a year. And each transaction, they know they don't have any support for it. What they're doing is wrong. Sometimes accountant is forced to enter it because his management told him to do that. I have experienced that also. When I went to the accountant, I said, why did you not tell me the gap between the $6 million gap? And his answer was straight. CFO told me to do it. What do you want me to do? Okay. Then I have to go to the compliance department, make a report against the CFO. But in certain countries, your ethics system, the controls and the standards are very high. What I could do in North America, probably you will not be able to do if you work in other countries. Okay, that I was openly able to go to the head of the compliance and make a complaint against the CFO, and that complaint stand. The CFO was not able to retaliate against me. He was not able to retaliate. Okay, so that kind of standard is not available in every country, but that's the right thing to do. Overstate purchase returns and allowances. Make it appear the liabilities are paid or forgiven. That means you will say, oh yeah, the vendor had has written off the outstanding bad debt. Okay, outstanding liabilities. So we don't have to pay. Sometimes that is recognized as a revenue. Any questions so far? Guys, if you have any experience that is similar, can shed light, please do share it. We will want to benefit from an interactive discussion. Now, how the liability is first committed. One is fraudulent recording of payment. Okay. Don't record accrued liabilities, or you manipulate it, because accrued liabilities is based on estimate. So when you're doing estimate, you can manipulate your estimate. And that's where the auditors comes in. They will try to understand why the numbers are changing. What was the change in the estimate? Don't record warranty liability or services. Now remember, warranty, it is a, for example, for an auto manufacturer, warranty is a liability for the auto manufacturer, but for the distributor who are selling the vehicles, for them warranty is a revenue. So if you're doing an audit of the distributor, then you need to understand that if they're manipulating warranty to maximize their revenue. If you're auditing an auto manufacturer, you need to understand whether the warranties be manipulated to reduce their liabilities. Like for example, when you buy a car, it comes with 3 years warranty, bumper to bumper warranty. That means anything goes wrong in 3 years period, the auto manufacturer will end up bearing that cost. So they have an estimate based on their projection for the experience in the previous years, how much will be their estimated liability. So if that estimate is changing, that needs to be disclosed in the financial statement also. Sometimes only disclosure is not enough as an auditor, only because they disclose the change in the estimate and you need to really make sure that change in that estimate makes sense before you sign off on the financial statement, before you call it an unqualified financial statement. Okay. Record deposits and revenue. Borrow against equities in assets. Write-off liabilities are forgiven. As I told you, your claim that your vendor has forgiven the liability and you recognize sometime as a revenue, and some of the financial statement for that has been identified by SEC and investigated by SEC that included this type of fraud, that they claim that their outstanding liabilities was forgiven by the vendor, and then they went and they recognized it as a revenue. For example, banks in certain countries, if you have if your bank customers, they have is unclaimed account. If it is unclaimed, after 5 years, you're supposed to give it back to the state. Okay, and the state will hold it in trust. Well, different countries different rule. In America, I think after 10 years, you give it back to the state. State will hold it in trust. Whenever they will try to identify the customer and give it back to them, or it will stay there in trust indefinitely. But some banks, what they do, they recognize this particular number as revenue. Okay, they should never do that. Every country, they don't allow that. They have their own controls that when the customer is not coming or account is dormant for a certain time, that money should be transferred to a trust of one sort or another. Before, you are not allowed to recognize it as a revenue. So if you're doing a banking audit, you need to pay attention to that condition. Now, what are accrued liabilities? I mean, we are all coming from accounting finance background, more or less we understand. It's liability incurred for goods and services, but not recorded because paperwork not received are often estimated. In fact, most of the time it's estimated based on usually prior performance. Excuse me. For a new company, it is little difficult, I understand, if it is a first year audit. But in that case, at least you have some industry trend, some rule of thumb that you can use to do the accrual estimate. But for a company that is being in existence for 20 years, you have enough track record to estimate your accruals. And I have seen accrual entries posted without any backing. It's just a big drop dead number. We don't even know if it is overestimated or underestimated. Both is wrong. Your estimate should be in the ballpark number. So your experience from prior and as you go forward, you should be able to estimate it properly. Now, how unearned revenues are abused? Instead of recognizing the liabilities, revenue is recognized and recorded. As I told you, sometimes some companies, you get the payment upfront for 6 months in advance or 1 year in advance. In that case, you need to allocate the revenue as you go. But in one case, what was a funny case, I mean, it was not intentional. We noticed there was error. It was a telecom company, telecom service company. They had a contract for 5 years with the government. And they immediately recognized the whole 5 years as a revenue for the first year. And then we went back, I said, hey, what are you doing? You can't do that anymore. You can't do that. Then we realized the accountant was not experienced enough and he didn't understand the contract and he just took the number and recorded it. And later on they fixed it. But again, when you are investigating fraud, you have to be able to differentiate between what is an error, what is not an error. Fraud is not an error. Fraud is an intentional act. So it could happen by not recording debt, that is a liability, understated revenue, and so liability is understated and revenue is overstated, and you don't have any necessary disclosure in the notes. Debts are forgiven. There is one claim. Sometimes you borrow for the business, but you show it as a personal debt or claim it as a personal debt. Now, contingent liability, this is a tricky thing. This whole thing is usually an estimate. But in America, usually this estimate for contingent liability relates to litigation. You have to go to the lawyer and they will tell you what is the probability of this particular case being lost. So the related liabilities. So you have to have a written confirmation from the lawyer disclosing all the liabilities, all the pending cases, and the outcome, potential outcome. And that will help you define your total contingent liability. Okay. Now, again, this is an estimate. So the rule is, I think this is the rule even US and under US GAAP and IFRS, both cases, that if the contingent liability is probable and estimable, we have to record the liability. That is, if you have a pending lawsuit for example, $10 million, and the lawyer comes and say that yes, the way the case is going, or the way, especially this is very, very important for pharmaceutical companies, because they have always pending lawsuit about their products, and based on the nature of the cases, they will be able to, the lawyer will be able to say, okay, this type of cases, the potential for the winning is high. If that type of report comes in, then you have to record the liability. If it's reasonably possible that they will win the case or you will lose the case, then you have to show it on the footnote under the contingent liability that this much is under the pending case. There is a possibility that company will lose the case, and we have to pay it off in a certain over period. Okay. And if it's remotely probable, that is based on the history and everything, we have 90% of the cases we are winning the case, then there's no need to even mention it. So here is the tricky come. This is all about probabilities. It can happen, it cannot happen. Okay, so you can tweak your judgment and keep it off the book. So that's where the auditors needs to be very, very experienced when they're defining contingent liability. They need to go to the right source to get confirmation and make sure that this number is not, there's nothing else is finding out. Usually that's why in the management letter, usually it is clearly mentioned, we get a confirmation from the management that they did not hide any kind of contingent liability from them. Okay, even then there are certain things for the bigger companies, you need to read the newspaper, you need to be familiar with different the media news to make sure that there's nothing funny going on. If you have a media news that company is going to lose this much money and so, and the company did not disclose it, that you did not pay attention to it, you'll be in a very bad situation. They underestimate the amount of probability. Okay. Now, what are the analytical symptoms of liability fraud? Remember, we talked about the 6 symptoms that we will apply towards every financial statement line items. So this is the analytical symptoms. Then what will be? The balance appear to be too small. It could be the liability section, it could be contingent liability section. When you compare with the prior years, it will suddenly drop to a level that you know. Usually in the case of external auditors, we use this materiality threshold. There is a certain calculation that you have to follow. So sometimes you have to compare your number against those thresholds to make sure that it falls below that number. Purchase returns and allowances seems too large. Unearned revenue, payroll taxes, payroll deduction, accrued liabilities, warranty balance appear to be too small. Now, compare with prior year balances. Compare with, if it is a, also take the quarterly number. Again, all depends on the risk that you assess about the particular customer. If you see the high risk company or in a high risk industry, you may want to take every quarter and compare the quarter to quarter for both years to get an idea if there's an unusual spikes and if there is any effort going on to manage it. Again, also you have to have some information about the month to month will help you also. As I told you, sometimes they spike it on the quarter because they have to file the report with SEC. I think it's Edgar database. Sorry, yesterday I forgot the database. It's called Edgar database. That's where all the SEC filings are there. 10K, 8K, whatever changes in front and filing with SEC, it will be there. And you should be able to get that information from the Edgar database. What symptoms appear in the documentation? Large purchases recorded at the beginning of the period. Photocopied records instead of originals. They will say the originals are missing. In those cases, you should go back to the customer, the source, and get the original. Strange difference between balances and confirmation. Oh, here is an interesting one. You know, this Parmalat or the fraud, I don't know if you guys remember it. It happened in around 2000, I think 2010 or something like that, sometime like that. It's an Italian conglomerate that was involved in the dairy products. One of their fraud was the cash confirmation related. They had $4.5 billion cash balance they claimed with an offshore bank account. Now, the auditor, they did not directly confirm the balance with the bank. But what they did when they made the inquiry with the management, they got a faxed bank confirmation. And if they paid attention, that fax did not come from the bank. That fax came from the CEO's office. That the $4.5 billion did not exist. It was completely fraudulent amount. So that was definitely significant for any company. Not recorded timely, again manipulating the period, sometimes keeping the period open or moving the transaction to the next month to smooth out the effect. Unsupported or unauthorized balance. So you have an entry that has no support, or if you look at the proper authorization, it is not there. Last minute adjustment. I think I have highlighted many times. These adjusting entries, you have to really pay attention. Too many adjustment, last minute adjustment, year-end adjustment, too many year-end adjustments. These are all symptoms of something not done right. It's not necessarily wrong, but you need to pay attention. In my case, I used to consult my customers that if I see too many adjusting entries, I used to give them a management letter note that if we see that, next time we will highlight it in the, that will be in the management letter, we'll report it. Okay, so we always used to encourage our customer to do the entries properly and to reduce the adjusting entries at the last minute or the year end. Missing records, denied access to records, facilities, vendors, or people. This is what happened in one of the cases we were doing. It was one of the multinational companies, and we were trying to get access to their warehouse. They basically were able to push back till the last minute. They were giving every excuses. Oh no, this warehouse does not belong to us. This warehouse belong to a subsidiary, which is we do not control any longer. So they have done everything to keep us away from that warehouse. So what are the some of the clues of liabilities fraud? So unrecorded liens on the property, no payment to the government, so the tax due, they are not paying it off on time. No payroll withholdings. That's another thing. You're supposed to withhold payroll taxes, and you are not doing or you know, in American case is a FICA, and you are not doing that. Capitalizing a wage. In certain cases, you can capitalize wage. For example, if you're doing a massive implementation during the equipment implementation, in those cases, people working on the implementation phase, their capital wage can be capitalized, but there are guidelines for it. So we need to make sure that those guidelines are followed. Interest with no recorded debt. Now, if you look at the whole thing, what can we do? This will be a good guideline for anybody doing a financial audit or reviewing the financial statement for symptoms of fraud. Okay, that is, focus on changes in statement numbers. Any unusual changes in the liability balance, you need to pay attention. Again, this is beautiful. I told you, cash flow statement is one of the most neglected statement. After all this fraud, after all this experience, you will notice that none of the analysts, very few analysts, pay attention to the cash flow. And investors also, they don't pay attention to the cash flow that much. But this is one area that should be paid high attention to, okay? Company like Apple, Microsoft, you know these companies are strong because look at their cash balance. Apple has about $200+ billion cash balance. Similar is Microsoft. I have a finance professor, God bless him, he passed away. And he used to say at that time, IBM was in trouble. And he used to say that invest in a company that has strong cash flow or they have strong cash balance, because this type of company, they can sustain loss, sustain downturn for a longer period of time. And because they have enough money to buy the talent to recover from those crises. And IBM, guess what? At that time, IBM stock was down to $50. It was in deep trouble, but they were able to pull out of that situation. So cash flow is a very, very critical function that we need to pay attention to. And use horizontal analysis to make sure that your balances have no unusual spikes. Liability relationship, examining change in relevant ratios. We'll talk about these ratios also today. Use vertical analysis that you compare the different components of the liabilities in comparison to the total liabilities. So if any unusual change in percentage, you need to investigate that and get a reasonable answer for that. The industry with competitors, compare statement results with those in the similar companies. Remember, I told you about the trend analysis with the industry trend. So only that your company is doing well, you need to make sure that it is in line with the industry. If it is not in line with the industry, that does not necessarily mean bad, but that requires additional investigation to make sure that those gaps you are able to explain. Compare companies' trend with those in the similar companies. Compare statement amounts with the assets they are supposed to represent. Okay. So what are the recommended process for examining for liability fraud? So these are some thoughtful questions that we need to have while we are doing liability fraud. Okay. Ask what kind of fraud could be occurring compared to the industry, compared to the balance that you're looking at. Keep in mind, just think about or research about what kind of fraud can occur in that particular segment. Identify what symptoms those frauds could generate. So look for those symptoms. So you need to do a little bit of studying and education, self-education or company should give you the training, or if you are the company management, you should provide the training to your team so they can think proactively. Determine whether those symptoms exist. Follow up to determine if the symptom signals fraud or abnormal caused by something else. So these are the thought process that you need to have, and you train your team. If you do that, so we should not just do audit as a routine process or review as a routine process. We should be critical. And one thing that is important is management should support that type of critical thinking. Now, sometimes what will happen is if somebody is too young, too inexperienced, they may delay or slow down the process, but don't discount them, don't discourage them. Train them, listen to them, and make sure that their ideas are, their thoughts are accounted for. Sometimes they will come up with an idea that you didn't even think about. And it's very valuable that we keep an open mind. Now, ratio analysis to detect fraud. Now, you can do balance comparison, but you can also do a ratio analysis and compare them from period to period to see if there's any unusual spikes, unusual number there. For under recording accounts payable, so these are the ratios that will give you a good indication. That is the acid test, current ratio, AP to purchase ratio, AP to cost of goods sold ratio, AP to total liabilities ratio, AP to inventory ratio. So these ratios will give you a good indication if there is an under recording of accounts payable. And especially if you have a trend, then you'll see if something is going on unusual. Under recording accrued liabilities, various accruals to number of days to accrued compared to same ratio in prior years. Various accruals to related expenses. Okay, this type of ratio will give you an indication if they're under recording accrued liabilities. Remember, when people are doing financial statement fraud, they're not really paying attention to how the ratio will be impacted. They are purely focused on the balance in total. Okay, they are really targeting their net income. Okay, so they are not really paying attention to ratios. So ratios usually will show these unusual activities. Then we have these blended ratios like Altman Z-score or M-score. These blended ratios even gives you even more, these are even more difficult to manipulate because nobody can do fraud about thinking about so many variables. Fraudsters are not really trying to be that creative. Okay, I mean, they cannot keep track of and go line by line item and try to manipulate that. They usually try 1, 2, or 3 line item at the top level and then try to manipulate that. So the ratio or blended ratio, they are good indicators. They usually will tell you a good the indicator of whether there is a potential problem with the financial statement or not. Under recording unearned revenues, unearned revenue to revenue. So if you do that ratio, compare it quarter to quarter, compared to year, you will see if there should be a pattern. If you see that there is a spike, then you know there is something going on. The ratios to detect this type of fraud. Okay, under recording service liabilities, warranty expense to sales. Okay, especially manufacturing companies, they usually have warranty liabilities, and for manufacturing companies this is very useful. For automotive industry, household goods, they all comes with warranty. Whenever there's a warranty issue, this particular issue is very important. Warranty liability is a real liability, it is not fake liability. Okay, and if it is not done properly, it can cause serious damage to the company, and the financial statement will be significantly materially misstated, and you'll mislead the investors, and you'll face litigation in a country like America. Under recording various liabilities, interest expense to notes payable, long-term debts to stockholders' equity, various types of debt to assets, total liabilities to total assets, pension expense to salary expenses, lease expense to total fixed assets, not recording contingent liability. Generally, no ratio to help you. You must look for documentary evidence. Again, contingent liability is a little bit difficult because it is about documentation. If they are hiding certain document from you, it's difficult. So some companies, what we used to do is create a schedule of all the contingent liability, and year to year we used to see if there is anything changing there or any new addition. It's almost like maintaining an inventory of contingent liabilities. For the auditor that's doing the audit on a year to year basis, they can develop that. And also you need to pay attention to the news. For larger organizations, multinational companies, you need to pay attention to the news media. You cannot ignore that, because what they may try to hide, you may find it in the news media. Okay, so then you need to go back and get those documents from the management. Define improper capitalization or expensing. Okay, recording some as an asset when it should be expensed. I told you about that there are certain conditions where you can capitalize certain item, but otherwise it should be expensed. Also, every company has a cap, like anything less than $5,000, you should be expensing it. So you should not be able to capitalize those items. Okay, so you need to understand the capitalization rule on the policy of the company and the accounting guideline to make sure that they are in line and they're not trying to fudge the number. In many companies, they try to do is capitalize the expense so they can reduce the expense amount. This change, so now the 5 common ways to overstate assets. Overstate receivables and inventory, overstate cash, short-term investments, and marketable securities, overstate fixed assets, overstate through merger and acquisition. This was done by WorldCom. They went on a binge acquisition. They acquired 30 plus companies within a very short period of time, and then basically doing all kind of funny number thing in that company. Overstate intangible or deferred asset. They're showing a lot of goodwills. WorldCom, Enron, they were all showing a lot of goodwills, and that has no basis. Now about, okay. The some ways we fixed assets are overstated is record at fair market value, especially companies like hedge fund, a banking institute. They have products, they have to do mark to market. And there's a lot of, especially the hedge funds involving the derivatives is very, very difficult to price it. Okay, you have to go to the vendor, the market maker, and get pricing from them. And my experience was when I was doing the hedge fund audit for the first time, I went to the market maker and requested the pricing, and they gave whatever pricing. So my manager looked at the sheriff, these guys are bullshitting. Go back to them, tell them that they're bullshitting. Okay, sorry for my French. Okay, so I went back to them. I said, guys, what you're giving me is not making sense. Then they gave me another number. Okay, so it was at the year end, during the Christmas time, they were busy to go on vacation, so they were just throwing out whatever they're coming just to get rid of the auditors. So we need to pay attention. That's where the experience comes in. That's where the supervision comes in. Record fully depreciated assets. Asset depreciated, you should be taking it off, but you're still keeping it on the book. Under depreciate, it should be the depreciation rule, you're changing it because and try to keep the asset in the book. Record non-existing assets. I told you that this particular company I was auditing, they claimed 3 properties that belongs to them. When I went for physical inspection, they didn't exist. So we had to take it off the book. That was not their asset. They were renting some space and they're showing it as their asset. Now, stocks are publicly traded. Okay. So here, the one that is publicly traded is not easy to manipulate because the market price is available. You can go and the historical price is there. But company like banks, hedge fund, they also hold a lot of assets. Those are not marketly traded, market traded, publicly traded. Those are, as I told you, the alternative hedge fund, the derivatives. These are usually you have to go to the market maker to get the pricing. There is easy to manipulate. We were investigating a particular hedge fund. This hedge fund, it was $1 billion hedge fund. Now it went bankrupt. And when we doing investigation, we realized they had 25% of their assets were market traded. Other 75% of the assets were not market traded. Those are privately held or derivatives or other securities. So what the auditors did to save time, they only confirmed the market traded securities, and the other 75% they had to do market maker. They had to go to the market maker or some other alternative way of the valuing it. They skipped it. So then we found out, in fact, one of the traders found out that some of these derivatives, they are extremely inflated price. So the trader raised the red flag. And when we were doing the audit, we found out that, yeah, trader was right. They only valued the market traded, which is 25%, other 75%, it was fictitious number. The whole company went bankrupt. A lot of investors lost their money. List of some symptoms of asset fraud. You have deferred interest, size of deferred charges, year-end reclassification or journal entries that reduce expense and increase deferred charges. See, journal entry is a funny thing. You can put any numbers you want. Our job is to make sure that those numbers making sense, that is supported. As I told you, you will hear the one word called topside entries. Usually we auditors, when we did financial audit, external auditing, we usually use the topside entry to do the adjusting entries. And some of it is legit, some of it is normal. They usually can't rely on the auditors to do some topside entries. That is okay. But when the customer is doing topside entry, then you have some issues. You detect those changes by comparing deferred charges ratios. So ratio analysis is a very good way of indication, finding out whether the symptom of fraud exists. Now, inadequate disclosure fraud. Okay, creating or misleading by providing incorrect information or not providing information. This is on the footnotes and MD&A. MD&A and footnote, these are both part of the financial statement. Don't think that this is not financial statement. Okay, these are critical. These explains all the foundation and the information about the financial statement. Now here I'll tell you an interesting story that I have is about just before the financial statement crisis of 2008. I was involved in the lot of the hedge funds audit. And I was working with a hedge fund administration company. So they were the books and records of hedge fund. And the one question came from the auditor to me that, okay, how do you guys price these securities, these derivatives? Each derivatives was 25 million minimum. Default swap, credit default swap, and all these items, the minimum amount was 25 million. And we have like hundreds of those in their books. So their question was, guys, how do you do the pricing? Because we are the books and records, independent books and records of the hedge fund, we should be technically doing the pricing on our own. So I went to our pricing head and asked the question, how do you do the pricing of these derivatives? He was very straightforward. Oh, we don't do any pricing. What do you mean by we don't do any pricing? I said, yeah, look at the footnote. We have a contract where it clearly mentions that the price is a manager price. Manager price means the person who is trading the security, he is doing the pricing. And in the footnote of the financial statement, it is clearly mentioned. And when I went back to the auditor, I told him that, yes, this is in the footnote, it is manager price. For legally, we are covered. Nobody can sue us for that because it is clearly disclosed in the financial statement. We as an organization also have a contract with to protect us from legal aspect. But a reader or investor, they should have seen the risk because it was clearly mentioned manager price. The price, there's no independent pricing there because nobody can do an independent valuation of these derivatives. Even Alan Greenspan, I was listening to one of his interview, he was telling, he's like, see, I am a pretty good mathematician. I have so many years experience. I have 125 PhD holders from top universities doing all the calculation and analysis. Even I cannot do the pricing of these derivatives. Okay, so these are such a complex instrument. Nobody can do a proper pricing of these derivatives. And guess what? That's what brought down the whole financial institution. Okay, so read the disclosure. But in this case, there was a proper disclosure. If you did not know, if the investor did not know how to interpret the disclosure, that is their problem. We as an auditor, we as an internal auditor, we need to make sure, well, this is not of a more of internal audit, this is more of a, anybody who's working in the financial reporting section and anybody who's auditing the financial report or anybody who's doing investigation. You need to understand what's written in the disclosure and what is not being mentioned in the disclosure. Okay, there is a saying that financial statement is like a two-piece bikini. It's not important what is disclosed, it's more important what is not disclosed. Okay, so that's what I did. I think that kind of specifies, tells you what needs to be looked at. Okay, but as an organization, they should disclose all the information that is pertinent. Statement of omission and statement of commission, we need to pay attention to those. Now, how footnotes are made misleading? Number one, you blatantly don't disclose it. You don't mention it at all. Or you say things in such a complex way that you don't really say anything. Then you have the contingent liability section that you don't mention the contingent liability. That is usually there. It is not in the financial, but a reader should know what can come to hit the company. Contractual obligations, you have contractual obligation or side letters that you are not mentioning in the disclosure. So company doesn't know, the investor doesn't know that there are other obligations created by side letters that is not in the financial statement. Significant event. Okay, now coronavirus, nobody can predict, but anybody who is going to do audit of an institution after this event, they need to look into that is it going to significantly change the outcome? For example, just think about it. Now, almost everybody is working from home. Now, one thing we realize, a lot of the things can be done from home. So what is going to be impact on the commercial real estate? So anybody who's doing commercial real estate, this is a significant event for them. How they're going to disclose it, how they're going to report it, that's a different thing. Because going forward, commercial real estate may not be that more viable because a lot of people can do really work from home. Now there's some term match that I will play, okay? So what is a mortgage? It's a long-term loan secured by real property. Acquisition, the purchase of something or company by another. So acquisition, you have to disclose also. Any significant acquisition that you're going to do or you're planning to do or you're close to doing should be disclosed, because that will have impact on your investor making a decision, whether it's a good decision or bad decision, whether they're going to invest in your company or not. Merger also, if your company is close to doing a merger, usually these informations are kept closed, but if it's significant, that's going to make a the impact on the investors or the creditors, you need to disclose it. Lease, that needs to be disclosed. Marketable securities, stocks and bond and cash. Deferred assets, that is capitalized expenditure to be expensed in the future. Okay, it's like goodwill. Fixed assets, you need to do a proper accounting of fixed assets. I have seen companies that had no clue about the fixed assets, or they were not recording the fixed asset on time. Okay, I have a company, the auditor resigned because this company did not simply have any control over the fixed assets. And it was so significant compared to the overall operation of the company, the auditor resigned. The funny thing is, I went to the shareholders meeting. The shareholders completely ignored the fact the auditor resigned and why the auditor resigned. They were fighting on other items. Intangible assets, the pension amount, sometimes the pension amount is significant. Remember, United States Postal Service, this company is on the verge of crisis because of their pension liabilities. Government has made them record or allocate the pension liability for future 75 years, and no company is required to do that, but US Postal Service is required to do that. That is driving the company to bankruptcy. It's like a design. The government is trying to get rid of Postal Service. That's a different issue. But I can tell you, the pension liabilities, it is a double-edged sword. Sometimes there are a lot of companies, after they went bankrupt, we realized that they did not allocate enough assets to the pension. And some companies that government is requiring them to so much, they become non-viable. Capitalization of assets. Now, liabilities fraud, like we talked about it, the liabilities are understated. Disclosure fraud, that is issuing financial statements with inadequate disclosures or not necessary disclosures not there. Asset fraud, the assets are recorded at a higher value than they should have, the valuation issue. Repurchase agreements, sometimes these agreements are not disclosed, and that could be a significant risk to the company. Now, understatement or liabilities fraud, that we are understating accrued liabilities. Usually the items that is understated are salaries payable, payroll tax payable, rent payable, utilities payable, interest payable. In some companies, these are very, very significant number. Understatement liabilities fraud, recognizing unearned revenue as earned revenue. I think we talked about it many, many times. A lot of companies do that. They have not earned revenue, but they need to boost up their cash flow in the paper. They will recognize the revenue right away. So we need to really understand, and for all these, for us to discover any financial statement manipulation, we really need to understand the company and its culture and the industry, and taken as a whole, we have to compare the numbers they're looking at. They try to do revenue manipulation by manipulating timing of the revenue recognition, because other side of the revenue is the unearned liability, unearned revenue, which is a liability. Now we need to also understand the motivation of this type of fraud. Okay, I told you that one of the motivation is the stock market usually interprets any change in revenue as a like revenue increment is a good thing, revenue reduction is a bad thing. They don't consider that this company is in business for how long, and is it sustainable? Is it making sense? It is practical to have a double-digit growth for 100 years. It's not. No company can be growing at a double digit for indefinitely. Okay, it's simply not sustainable. The market play is not going to allow that. Other players will come in to take advantage of that type of the opportunities. Under recording future obligations, I told you for manufacturing companies or any company that is a warranty issue, that needs to be looked at in details, and the service obligation that is there, that needs to be looked at and make sure that it's disclosed properly, it's accounted for properly. Because these numbers are estimate, it's easy to manipulate. Not recording or under recording various types of debts, they're either not reporting or under recording of debt to related parties, borrowing but not disclosing debt incurred on the existing line of credit, not recording loan incurred, claiming that existing debt been forgiven by creditors, claiming that debt on the company's book is personal debt of the owners or principals rather than debt of the business. Now remember, these things are not done by accident. These are by intention. We're talking about fraud. Nobody will do it. If you find it and they'll tell you that, oh no, I did it by mistake, don't believe it. Go deeper into the issue. Okay, you need to take it in account whether it is a management making the ethical issue. If it is an ethical issue, maybe you should consider your relationship with the company. Be an auditor or an employee, because one day you will get into trouble. This type of thing will snowball. Nobody can say that, well, I'll do it today, tomorrow I'll forget. No, it's not going to happen. And the broker dealer I told you about, I think yesterday, the alternate hedge fund broker dealer, that dealer made a mistake of, the owner made a mistake of borrowing 500 million from the company as a personal debt and not disclosing it. Later on, he admitted it and he put the money back, but it was too late. People already lost confidence in the company and company went bankrupt. Then we found another issue that they did not segregate the fund of the customer from the company fund. The commingling fund created another issue. So unfortunately, it's really, really unfortunate. Understatement of liabilities fraud, omission of contingent liabilities. The likelihood of loss is reasonable possible. The contingent liability should be disclosed on the footnote of the financial statement. Contingent liability can be used to fraudulently misstate statement by underestimating the probability of occurrence and not recording or disclosing contingent liability financial statement. We talked about it, especially in the pharmaceutical industry. This is a big, big issue. If you're auditing a pharmaceutical industry or reviewing a pharmaceutical industry, this is a big issue, especially in North America. Understatement of liabilities fraud. Ways to detect understatement liabilities, analytical symptoms. We already discussed all these items, okay? For accounts payable, again, we're recapping it. Accounts payable, the balance appears too low. Cost of goods sold numbers are low. You need to pay attention to those. Unearned revenue, payables, or other accrued liabilities are too low. Income that is often too smooth. Again, I told you the revenue management thing, that they try to smooth out the revenue. If you see that it's too smooth, then you know it's not possible. It's simply not possible based on the reality. You cannot have that consistent revenue coming in all the time. Recognition of unearned revenue. Unearned liabilities balance appear too low or revenue accounts appear too high. Non-recording of service or warranty. Balance in warranty, repurchases or deposit accounts appear too low. Again, you have to compare with the industry. You have to compare with the year-to-year balance and see which way the trend is going. Unrecorded contingent liability. Analytical symptoms are not particularly helpful because contingent liability, you don't have a balance. You have a description. So you need to really understand the description. For a recurring client, you have a little bit good record of contingent liability from last year. You need to look into that and see what other things have happened, and also pay attention that if anything happening in the industry, in the country, or anything in the news media that may have impact on the company's operation. Okay, so you need to disclose that. I'm sure if you look at financial statement that will come out this year in June, company with June year end or after that, you will see a segment on contingent liability on COVID. I can guarantee you on that one, because that's a significant event and some companies will face serious liability issue because of what is happening in the last few months. Under recorded notes and mortgages, unreasonable relationship between interest expense and recorded liabilities, significant purchases of assets with no record debt, recorded amounts of notes payable, mortgage payable, lease liabilities, pension liabilities are too low. Now, these are symptoms you have to think about, you have to consider this in overall, that if these symptoms are available, do you have enough information? And put it together. There are 6 symptoms, put them together and see if there is a picture coming out. Of course, photocopied records, we talked about it, unusual discrepancies, transaction unrecorded in a complete or timely manner, balance or transaction that lacks supporting document, missing document, unexplained items or reconciliation, denied access to records. We discussed this in the past in detail. Now we're just recapping it. Now, overstatement of assets fraud, what is happening? Overstatement of cash, short-term investment, marketable securities, overstatement of receivables and inventory, overstatement of fixed assets, overstatement of asset through merger acquisition or by manipulating intercompany accounts and transaction. The merger acquisition, it was the WorldCom, particularly WorldCom, they did a great job in that one. Overstatement of intangibles and deferred assets, both Enron, WorldCom, they all did that. Okay. Overstatement of fixed asset by leaving worthless and expired assets on the book, under-reporting depreciation expense, overstate asset cost with related parties, colluding with outside parties to overstate assets. I told you about the telecom industry. At one point, these 4 or 5 companies that was almost each was helping the other. Fabricating fixed assets to record on financial statements. Now, overstatement of receivables and inventory. Cover thefts of cash or other assets by overstating receivables and inventory. Okay, you're not recording it properly. Overstatement of cash, short-term investment and marketable securities. Reporting restricted cash and unrestricted cash. You know, restricted cash, that is almost like sometimes you have a cash balance, but you have the bank, what is that, agreement or the lien on certain amount. So you have to show that certain amount is restricted. But sometimes what you can do, restricted means, you know, investor know that that money is not available in any kind of circumstances. So they can disclose the unrestricted amount as a restricted amount, unrestricted amount. Suddenly cash balance looks better. Having a vendor or employee steal significant amount of cash over time, so the financial statement are misstated. And remember, again, I will come back to cash balance. It is really difficult to manipulate cash. Every other balance is easy to manipulate. Cash statement is extremely difficult to manipulate. Unless they really go back, like what I told you about the Parmalat. The cash statement was overstated because of the fraudulent bank confirmation, but the auditor should have paid attention that it was a faxed confirmation. I remember, I think nowadays a lot of confirmation you can do from the bank electronically, but at that time I remember when we are doing audit, we used to pay particular attention to get a direct confirmation from the bank, not from the customer. We will not go to the customer. We will call the bank directly and we will get the confirmation by mail, not by email, not by fax, so that we know it is coming from the right source. Now, if that document is manipulated, we are covered, because if the bank is, somebody from the bank is doing that, that's bank responsibility. But that's why I'm telling you that all kind of financial statement we have seen, very few cases they try to manipulate the cash. And if the cash is manipulated, auditors will have a difficulty to justify how they missed it. Okay. Use market value rather than book value to record assets. Have the wrong entity be the purchaser or related party, allocate cost among assets in inappropriate ways, record fictitious assets or inflate the value of assets in intercompany accounts and transaction. This is another thing. A lot of the offshore trading that happened, if we consolidated those, then intercompany transaction would have washed out and the real picture would come up. But they were able to, by not disclosing the right relationship, or sometime at that time the auditors using the rule-based method of deciding whether the consolidation should happen or not, they kept the significant transaction off the balance sheet. They did not do the consolidation, and then the real picture did not come out. Overstatement of intangible or deferred assets, especially in the startup companies, this will be something that you need to pay attention to, because they will have a lot of intangibles. There are a lot of capitalization and deferred assets that you need to pay attention to. The way we can detect overstatement of assets are compare changes and trends in financial statement account balances, compare change and trends in financial statement relationships, compare financial statement balance with non-financial information. Now, non-financial information is very, very important. Don't always take the financial number I told you. If your revenue is going up and your number of outlets are going down, you should raise question how that is happening. Compare financial statement balance and policies with those used by the similar companies. Okay, so your accrual percentage in your company and similar company, how they're doing it, or industry, that you need to take it into consider. And the disclosure fraud, of course, the misrepresentation of the nature of the company and its products, misrepresentation or omission of MD&A. MD&A is a management disclosure and analysis. If you look at the financial statement published for a listed company, you'll see the discussion of the management. Of course, they will do a lot of rosy picture, but even that one has to be audited by the external auditor, and they have to agree that that will go as part of the overall package. So if there is a blatant misstatement, too much rosy picture there, that auditor needs to be concerned, because if they sign off on their financial statement, they will be held liable. Misrepresentation or omission in the footnotes in the financial statement, we talked about it. Now, disclosure fraud, you need to have a very good understanding of the financial statement and the gap, how it needs to be disclosed and what needs to be disclosed. Each line item is balances. You need to have a good understanding of the company policies. In US, I used to use, we have this particular publication called Accounting Disclosure Trends and Techniques, that usually gives you the key aspect of trends and techniques. Okay, I think I have some questions here. Let me see. Okay. Make the necessary inquiry with the management and review the company's files and records with the SEC and other regulatory authorities. Okay, I have a question here. One guy asked, if provide your online training, send our email. We will print from email. I didn't understand the question. If Mr. Mozammel, if you can state the question again. Our training will be recorded and posted on our YouTube channel. You'll be able to listen to it whenever you need to refer for any purpose.
Mr. Shoaib, thank you. I have a question.
Yeah, go ahead.
After training session in, then I will ask the question.
Okay, sure. We'll do that. Again, you need to go to your regulatory agency. If it's a listed company, you need to go to regulatory agencies. In the SEC, you have the Hoover database, Edgar database. where you can go and find all the filing details about the listed companies and get it from there. In other countries, you have their own SEC or similar organization. You can go and get a lot of information about the listed companies. Also, you have the different registration companies, different industry database. They maintain information about the company, about the owner. You can go there and get the information. So that's all for today. I know it took him a little longer today, 1.5 hours almost. Thank you very much for your patience. So if you have any questions, please feel free to shoot.
Thanks, Sharif. Appreciate it.
Welcome. I hope it was useful.
Yes, it is. Thank you.
Any questions from Mr. Muzammil?
Firstly, thank you very much to you for us training session, and it will help us in our practical life. So I have a request to you. If I can get any online certificate for registration, that will help to us our career life, and we also submit in our office.
Okay. What you can do, just share your information with us. We will issue online certificate. Okay.
Okay. Thank you very much.
Welcome.
Because we have a
Which company do you work for?
Ispahani Group.
Ispahani Group. Okay. Okay. Yeah. Do share, because we will try to have more session like this. Try to see if you can have more people, because the more people